Alright, hi guys. It's been quite some time since my last video and there are two reasons. The first reason is because I've not been feeling too well, been under the weather for some reason, having this cold that won't go away. But at the same time, I'm like so busy with my home renovation, which hopefully will end in the next 2 months. So in this video, there are a couple of things I'd like to talk about. And the first thing is, of course, this lawsuit that's brought by the Department of Justice accusing Apple of being a monopoly, wanting to break Apple up, and that's of course creating a lot of short-term negative sentiment towards the stock. So as investors, is this something that we should be concerned about or an opportunity to take advantage of? The second thing I'd like to talk about is one of the stupid things I did this year. And it's one of those things where you know you shouldn't do it, you told yourself you shouldn't do it, but you still did it, and it cost me thousands of dollars. Yeah, it's a really dumb move. But more on that later on. But before that, let's take a quick look at how's the market been doing so far this year. It's been extremely bullish, it's been extremely resilient, even more bullish than I expected. So year to date, the S&P 500 is up 10.3%. My portfolio is just only slightly beating the S&P so far this year, up, let's see, year to date, yep, up 10.86%. But on the last 12 months basis, up 42%. So, I think a lot of us, including myself especially, I expected sell-off, a correction of at least 5 to 7% in the month of late February to March. It didn't happen. The market so far has only made very small dips, as you can see, right? It dipped, and it keeps finding support at this very strong 20 exponential moving average. And so far, the dips have not been more than 2%, and it bounces back up again. Now, bear in mind, of course, this will end eventually. Eventually, you're going to get a bigger correction. We just don't know when it's going to happen. But what's interesting is that we are now going to the month of April, and historically, April is a very strong month in the market. So some of you may say, but February and March was supposed to be a weak month, so now will it be the reverse where now April is a weak month? Well, we don't know, right? Who knows? But then again, it could be that the weak months of March is over, and now April's going to be bullish, and the other window for weakness will then be August and September. So why is the market so exceptionally strong so far this year? Now, this is even though we didn't get the rate cuts the market expected. If you guys recall, at the beginning of the year, end of last year, the market was expecting the Fed to cut rates 7 times. And then they then said, okay, maybe they're not going to cut 7 times, maybe cut 3 times. And then now they say maybe they're not going to cut at all. But then, of course, the Fed came out a few days ago during the FOMC meeting and then reaffirmed that they're going to cut rates 3 times. So the rate cut expectation has dropped a lot, but still the market's so resilient. And I've got 3 possible reasons. The first reason is because earnings have been very, very strong, stronger than expected. So ultimately, share prices are driven by corporate earnings. The second reason is because a lot of people have been left out of this bull market. There's over 6 trillion of cash on the sidelines sitting in money market funds. So these are the institutional investors. These are a lot of retail investors that miss this rally. And so every time they see a dip in the markets, they are taking the opportunity to get into the market. So we've got all this dry powder out there constantly, pumping into the market, so the market can't go down very much. Another reason is because the amount of margin debt that's being used by investors to buy stocks is actually very, very low. Historically, a lot of people, they use borrowed money to buy stocks so that inflate stock prices. And when prices come down, they get margin calls, they get forced sold, and the markets come crashing down very, very fast. But now a lot of the buying is done with cash without the use of margin. So when people don't buy out of margin, they're not forced to sell when the market drops, so you don't get such deep corrections. And I think the last reason why the market is so strong is because people are beginning to realize something I said last year, that hey, we are not just at the start of a new cyclical bull market, but we are actually at the beginning of a strong secular bull market that's driven by the 6th wave of innovation, the AI and the AI revolution, the AI automation revolution. And we can expect this bull market to continue for the next 5, 6, 7 years. And people are now beginning to realize that we're going to have a lot more productivity, a lot more earnings growth from companies that deploy AI. So they are panicking, they are getting the markets, and that's what's driving the markets higher. So that's the good thing that's happening. And that is why I keep saying at the beginning of every year that no one can predict the market. Anything can happen. And that's why we never ever invest and trade based on predictions. So even though I anticipated that the market would drop in March or February, did I short the market? Did I sell stocks? No, I didn't short the market. In fact, I kept holding my stocks and I kept entering more option trades that were long the market. So I never invest and trade based on my predictions because I know my predictions are as good as the predictions coming from your cat or your dog, right? So my investment decisions and my trading decisions is always based on what's the current trend of the market. As long as the market is on a clear uptrend, you can see the 20 EMA above the 40 EMA, you're seeing higher highs and higher lows. You see the 50 moving average above the 150 moving average. You see the 200 moving average sloping up. The market's in a strong uptrend. As long as the market's on an uptrend, you stay long. When you're trading the market, you take long trades, you don't short the market. If you short the market when it's on an uptrend, it's like swimming against the current. Most of the time, you're going to get drowned and dragged down by the current. And when it comes to investing in great companies, I don't sell just because it went up a lot. As long as the company keeps growing, as long as it's undervalued or even slightly overvalued, I keep holding these great companies and let them compound into huge amounts over time. And that's why a month and a half ago, I advised my students, I said, even though we expect a correction, don't short the market, don't sell a stock, keep holding it, right? Keep going long. And sure enough, we've done very, very well. And people who didn't listen, they shorted the market, they all got killed. All right. So I find that every time you try to outsmart the market will give you one tight slap on the face. So let's jump into the topic at hand, which is this lawsuit against, in fact, Google recently and now Apple, accusing them of being monopolies and engaging in unfair practices that are not fair to competition, that hurt consumers. And of course, this is threatening to break up the companies, threatening them with huge fines. And when I read this, I was very, very disappointed. Disappointed that Apple didn't drop enough. And that's right, it just dropped a bit, not enough, because I want to buy more. Anyway, but some people, they panic when they read things like that. They say, oh my God, Apple's going to lose their competitive advantage. Google's in trouble, going to sell Google and sell Apple. Oh my God. And they get really, really worried, right? So the first thing to understand is that when you invest in great companies, like for me personally, I only like to invest in monopolistic companies that have little or no competition. Your Apple, your Google, your Microsoft, these are freaking monopolies. I love to invest in these companies, as well as United Health, which is a monopoly in the managed healthcare space. So you gotta understand that when you invest in great monopolistic companies, they will get sued all the time. It's very common. So is it something that we should be concerned about? That could it affect the long-term profits or the economic mode of the business? Well, history says no. In fact, history says that whenever these companies get sued and people panic and there's a lot of negative short-term reactions to the stock and the stock drops in the short term, those are always great buying opportunities. By the way, if you read the actual Department of Justice, their lawsuit against Apple, I think it's full of crap. All right, so they are accusing Apple, for example, of being a monopoly. They are saying that people who use Apple have no choice but to use Apple, and you lock them into your ecosystem. I mean, what kind of crap is that? What do you mean? No choice. I mean, if you don't like Apple, don't use Apple. You can use Samsung, right? You can use Xiaomi. What the hell are you talking about? It's really full of crap. And one of the examples they gave was they said that Apple, their smartwatch, it works very well with the iPhone, but it doesn't work well with other phones. And that is anti-competitive or monopolistic practices. I mean, what kind of crap is that? Obviously, if I'm Apple and I'm creating a smartwatch, my smartwatch should work the best with my iPhone because it's part of the ecosystem. In fact, that's what I love about Apple. One of the things that you got to understand about Apple is that what gives Apple their strong economic mode is not the hardware device itself. Now, for example, does Apple make the best smartphones? No, all right? So you may find that Samsung or Huawei or Xiaomi, they may have more features, they may be more affordable. So Apple doesn't make the best phones. But Apple's main advantage is not the individual phone or the individual computer, it's the ecosystem that they built where everything works seamlessly. So for example, my Apple Watch syncs perfectly with my iPhone, with my MacBook, with my iPad, with my AirPods. Everything is synced to the iCloud. Makes my life very, very convenient. So for me, will I ever buy a Samsung phone or a Huawei, even if it's cheaper, it's got more features? No, I'll never buy it. Why? Because if I buy it, it's going to make my life more difficult because it can't sync easily within my Apple ecosystem. So that is what gives Apple this so-called strong moat that causes customers to stay with Apple, right? So the Department of Justice is accusing them that that's a monopoly, which I think again is complete rubbish because that's their moat. Now, can I leave Apple if I want to? Of course I can, all right? So I think it's full of crap. But anyway, the interesting thing is this: even if they do have a case against Apple and Google, for example, and the Department of Justice wins the case, history shows that these companies not only are not affected in the long run, they actually become even stronger. And I think one of the best examples to go back to is Microsoft. Now, Microsoft has been around for 49 years, and ever since 1990, they've always been sued for anti-competitive practices. They've been constantly sued for being a monopoly, and the government has always wanted to break them up. But despite that, today they are still one of the strongest companies around, even stronger than where they were 40 years ago. So this is a timeline of Microsoft, and you can see that starting in 1990, the Federal Trade Commission, they sued Microsoft for attempting to monopolize the PC market. And guess what? Microsoft kept going up. So in the short term, there's a dip because people are afraid of lawsuits, but the market has a short-term memory. After a while, they're like, huh? What lawsuit? We forgot about it, right? And eventually, most of these lawsuits, the government eventually doesn't win it in the end, right? They can drag for years and years and decades. A lot of times, the government doesn't win. And even if the government wins, what usually happens is the company will then appeal. And after appeal, after appeal, after appeal, usually the government will then give up. All right, that usually is what happened in this capitalistic system in the US. Because ultimately, a lot of the politicians and so on and so forth, they are invested in these companies as well. Do you think they want to see their investments go down? Of course not. They're going to support these investments. And even if these companies lose the lawsuit, in this case, by the way, Microsoft was sued again in 1998, again, after they lost, the government lost, they sued again. They sued Microsoft for antitrust bundling of their products. And in fact, guess what? The government won the lawsuit. Over here, you can see that the government won, and Microsoft was ordered to break up the company and to pay a huge fine. But what happened? In the end, again, they appealed, and through politics and all that, it was all dismissed, and Microsoft just paid a small fine, and that's it. And then in 2004, the European Commission sued Microsoft as well. And in the end, they settled it for $794 million fine. And today, Microsoft is again at an all-time high. By the way, this drop that you see over here was not because of losing the lawsuit. It had nothing to do with that. That was a dot-com crash that affected all technology companies at the time. And of course, this period of time when Microsoft went sideways, again, had nothing to do with these lawsuits, was because Microsoft was, in a way, mismanaged by the CEO at that time, where they were not able to innovate any new products, right? It was when Satya Nadella took over Microsoft that it changed the fortune of Microsoft. So, in a nutshell, again, it doesn't really affect the company in the long run. Another one is Facebook, which is now known as Meta Platforms. So again, Facebook has been sued so many times by so many government agencies. So the most recent one was in 2020, the Federal Trade Commission again sued Facebook for antitrust practices, for buying up Instagram and WhatsApp and creating a monopoly in the social media space. And the FTC lost the lawsuit, right? So Facebook won. And they said, okay, part 2, we're going to sue you again. So in 2021, they sued Meta again with new charges and stuff like that. All right. Over here you can see, right, FTC loses the antitrust challenge to Meta, right? But again, who cares? It went down temporarily, Now Meta again at all-time high. And of course, most recently we have got Google. All right, again, Google has been sued so many times I've lost count, okay? Most recently in 2020, Google was sued by the Department of Justice, and they were sued for paying Apple billions of dollars to put Google as the default search engine in Apple products. And then most recently in January of last year, the DOJ sued Google again for monopolizing the market for digital advertising technologies, right? They keep going after these companies. But again, what happened? Yep, short term, the market panics a bit, but now Google looks like it's going back to all-time highs. The market doesn't give a shit about this eventually. So I always use these lawsuits as opportunities to accumulate more shares, as long as it's a great business. Like I said just now, I'm pretty pissed off that Apple hasn't dropped enough because I want to buy more Apple shares and it's still not undervalued. You can see my intrinsic value that I calculated on Apple is $168. This is using my intrinsic value calculator, and right now it's still not cheap enough. So what I did was, in order to get paid to wait for Apple to drop further, I've been selling cash secured put options. So that's what I do almost every day. For example, you can see over here, right? So I sold Apple put options. I sold like 3 contracts at the 165 strike price for a 296 premium I collect. So by selling these put options, basically what's happening is that I'm obligated to buy Apple shares if the price closes below 165 by the date of expiration. And for me to buy Apple shares at 165 less the premium I collected, I'll be very happy to do it because I want to buy as much Apple shares as I can to build a bigger position, right? And of course, if Apple goes up, which I hope it doesn't, then I don't get to get the shares, but at least I collect some free premium along the way. But I do hope Apple will go down a lot more. Finally, let me tell you the stupid thing that I did this year that cost me thousands and thousands of dollars. And the stupid thing I did was selling covered calls on some growth stocks like Nvidia and Meta that caused me to sell some of my shares too early and missing a lot of upside potential. So the first was, of course, Nvidia. So my average price of Nvidia, which I entered, was about $150, right? So you can see over here, that was my average cost of getting into Nvidia. Now at that time when I calculated, the intrinsic value was something like about $300 at that time before their earnings results came out, right? And so when Nvidia went up to about $380, about $300 plus dollars, I sold covered calls on some of my positions at a 380 strike price. So what that means is when I sell covered calls, I collect premium because I thought that, okay, it's going to go sideways, it's going to go down, sell some covered calls. But then what happened was that Nvidia came up with great earnings and the share price flew up. And by selling those covered calls, I was then obligated to sell my Nvidia shares at 380. Ouch, right? So essentially what happened was I bought Nvidia at 150 and then I sold it at 380. So it was really a dumb thing to do. But the good thing was that after I was forced to sell my shares, I recalculated the intrinsic value based on the new earnings, and I found that the valuation was now, let's see, the new valuation is about $679. So I realized that, oh my God, now the company's worth more, and I sold it when I was still cheap. So what did I do? I bought it back. So I bought it back. But of course, I couldn't buy it back at 380. So I bought it back at about 400 and about 500. So you can see right here, in my 2 accounts, this is my first account over here. There we are. So right now you can see my Nvidia, right? My average price is 500, but I've only got 115 shares, right? So yeah, I've made about 47,000 on this, but it's because I didn't buy back all my shares. I only bought back part of my shares. And on my other account over here, you can see same mistake, right? My average cost is about $500, and I'm up about 54,000 over here. So yeah, I've made a few $100,000 on Nvidia, but the point was I could have made a lot more if I didn't get a sign on my covered calls at about 380 and having to buy Nvidia back at $400 and then $500. So the important lesson here is this. Now, a couple of years ago, I made this decision to not sell covered calls on growth stocks, because growth stocks, they can explode very suddenly. And when you sell covered calls, you get some premium, but once they explode, you miss a lot of the upside. That I should only sell covered calls on more defensive stocks like Pepsi, like Procter & Gamble, like Nike, lower growth stocks, right? But shouldn't sell on high growth stocks. But I didn't follow my own advice. I sold covered calls on Nvidia and Meta, and because of that, my shares got sold away. So that's something which was really dumb. But I think what I did that kind of like mitigated it was that once I recalculated the intrinsic value and realized that now the company's worth more, I quickly bought it back. So the lesson to learn is this, is that if you sold a stock like Nvidia at 380, you have to buy it back at 400 to 500 if you know it's worth more. And that's what I did. Of course, I didn't buy back everything, I wish I did, but I bought back about half. And you can see, although I have got still Nvidia in my portfolio over here, but it's a lot smaller than what I used to own. I used to own a lot more shares, right? So that was a really dumb thing that I did. And if you look at Nvidia right now, do I want to buy more shares? Yes, I do. But I have got to be patient because my recent intrinsic value that I calculated is 679. And this valuation is based on a 34% growth rate for the next 5 years and then 15% for the following 5 years. That's how I got the 679 valuation. So I'm just hoping that, if Nvidia could retrace near the 679, right, or below that, then I will start to accumulate a lot more Nvidia shares. But you never know. The valuation of Nvidia may be revised upwards, right? When they next announce earnings, maybe the valuation could go up to $800 to $1,000. Personally, I'm very bullish on Nvidia, especially after their very recent event where Jensen Huang, they announced the new Blackwell chip. So the new Blackwell, well, it's not just a chip, it's an entire ecosystem, it's an entire computing platform that's headlined by the B200 chip. This B200 chip is a 208 billion transistor chip. How big is that? Well, basically, it is delivering 2.5 times the performance in training AI compared to their current chip architecture, right? 2.5 times more. And for inference, which is using AI to infer new stuff, it is running 5 times faster. So they are now pulling even further ahead of AMD, which used to be their competitor. And that's why you notice AMD recently, the share price has been falling because you can see Nvidia really pulling ahead. And not only that, not only is their Blackwell chip faster, but it's 25 times more power efficient. And that's why now a lot of the big tech companies like Amazon, like Tesla, and so on and so forth, they're all partnering with Nvidia's Blackwell chip. So one of the things that you got to understand about Nvidia is some people say, but Amazon and Google, they are making their own chips. Wouldn't that be a competitive threat to Nvidia? Not really. So the thing to understand about Nvidia's economic mode is very much like Apple. What do I mean? Now remember, Apple's economic mode doesn't just come from their great hardware. It comes from their ecosystem, making the hardware and software work seamlessly together. The same thing with Nvidia. So Nvidia's main advantage now is not just that they can make the most advanced chips that Intel and AMD can't make. No, but Nvidia's advantage is that they have these advanced chips that works within an ecosystem that locks in their customers into this ecosystem. And the ecosystem consists of the chips and the software tools like CUDA and their services all working together. So even if Microsoft and Amazon and Google make their own chips that are just as good, they can't use the chips together with their NVIDIA software because it doesn't sync as well, right? And to train all their engineers to use their new chips or new software will be too expensive. So they will continue to use NVIDIA chips because they're locked into the NVIDIA ecosystem. And for the new chips they develop, you'll probably be used in other applications that they are not using NVIDIA for. So that's why I think that NVIDIA has got a long way to run. If you ask me, is NVIDIA a bubble? Is it overpriced? Right now, it is slightly overpriced by about 30%. But I think that if Blackwell really performs very well, their valuation could catch up or even exceed their current price, and they could potentially go up to $1,000 to $1,500 in share price. So again, I'm watching it very carefully, and I'm again kicking myself every day for selling some of my NVIDIA shares, but at least I've got still some in my portfolio. But in the meantime, waiting for the share price to drop, but selling cash secured put options. I can see I recently sold NVIDIA put options at 725 strike price for $10.58 premium, which basically means that if NVIDIA drops and stays below 725, I'll be obligated to buy 100 shares of NVIDIA at 725 less the premium. I'll be paying about $715, which is to me a reasonable price to pay for NVIDIA shares, which is roughly near the intrinsic value. And I'll keep selling puts on NVIDIA, and hopefully I get assigned the shares. And if NVIDIA keeps going up, then what to do? I just get the free premium from selling those put options. So those are my recent thoughts about what's happening in the markets. I hope you enjoyed it, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.